So hello and warm welcome to this Alphatax 20.1 product release showcase. My name is Jonathan Rowley. I'm a tax developer here at Tax Systems. I'm involved with all aspects of maintaining and enhancing the tax tools within our products, including Alphatax. Before we begin, I'll quickly go over the agenda for today. So the aim of today's session is to talk you through the more important changes included within the Alphatax 20.1 release, which was made available on the 22nd of January to our professional customers, and then in February for our enterprise and hosted customers. Please note that you can use the Q&A tab and pose any questions throughout the presentation, and I have a couple of colleagues who are listening in and will do their best to answer. So let's get straight into it then, and where we're starting with is tax returns. So there's three main tax returns that we support within Alphatax UK, which are the company tax return, of course, but also two self-assessment forms for non-resident companies and partnerships. The two self-assessment forms are annual returns, and so a new version is published every year, whereas the company return, or not technically an annual return, HMRC have actually published an update every year for the past 5 years now. The changes we tend to see are limited to a handful of boxes being added or removed in certain areas, most commonly for capital allowances, for example. But this year, there have been two bigger, more structural changes we've had to consider. It's worth bearing in mind, if you're like me, when you think of a tax return, you think of a piece of paper with multiple boxes on it. And indeed, I will show you some screenshots of those in a few slides' time. However, two of these returns have electronic submission mechanisms. And so whilst Alphatax does, of course, include these, as this is what everyone is used to working with, there are XML versions which sit behind the scenes that are also updated, and it's this part that is actually submitted to HMRC. So with that bit of clarification out of the way, the first form update we'll talk about is the biggest and the one that causes the most challenge. And it's an area that in most cases, Alphatax should be able to deal with automatically. You may be able to guess from this beautiful picture that it relates to research and development, of which of course is a large area in the world of corporation tax. Across the SME and large company RDEC schemes, there are around 60,000 claims made by businesses each year, with an effective cost to the Treasury of over 5 billion. When you consider that the whole corporation tax nets around 60 billion in total, deductions of 5 billion is pretty significant and a big deal. The claims process up to this point has been relatively unstructured though. There are a couple of boxes on the form that you'd populate, but there's no formal way to actually prove these figures. HMRC have been signalling for a while that they were going to tighten this process in order to reduce possible fraud. And so they've taken the steps this year with the introduction of a new supplementary form, which for sequential reasons is called the C600L, which hopefully you can see these 4 screenshots. So the new supplementary forms compromises of 46 boxes across 4 pages and has to be completed by companies claiming an R&D tax credit in their return. The form is primarily aimed at large companies using the RDEC scheme and works through the numbers for the existing 7-step legislative calculation. The SME scheme is also represented here, although only through a handful of boxes on the last page, which relate to when you're surrendering losses for a tax credit. So the main feature of the SME scheme, being the 130% super deduction, is not actually included on the form. So whilst it's somewhat confusingly called the research and development, not all aspects of R&D are actually covered, which may take some time for taxpayers to get used to initially. This new supplementary form is capturing the details of our existing rules, so there's no new legislation here at all. Therefore, as you'd expect, we did already have the statements and calculation we needed within Alphatax. Thus, much of our work related to aligning our existing code with the requirements of the new return guidance notes. Those beady eyes and familiar with the contents tree will notice that in the screenshot here, that our RDEC statement has been moved from its previous location under the corporation tax computation section of the contents tree, and now sits within the C600 supplementary form section. In addition, we've updated this statement to include 600L reference boxes for ease of use. The new supplementary form is largely completed automatically based on inputs on the existing statements that everyone should be familiar with, they've been used. However, there are a handful of additional inputs that have been added to capture certain aspects of the form that we did not previously cover. The two main examples of those are as follows. If you are claiming an RDEC as an SME and the rate changes, you have to confirm the split between subcontracted and subsidized expenditure. And for companies who receive an RDEC tax credit from a partnership, there's now a new box to enter the associated expenditure. The new supplementary page has to be used for all new or amended submissions which are made from the 1st of April 2021. Technically, this form forms part of the version 3 of the CTGOOL and is so is applicable from periods starting on or after the 1st of April 2015. However, as this form can lead to differences on the return and in terms of the credit the company is entitled to avoid changing previous computations, we've added our own application date control for periods of account ending on or after the 1st of April 2020. However, if you do have a situation where you have a return from before that date and you are looking to resubmit, for example, to include an amended claim, we added the above flag on the submission options input statement to manually switch on the new disclosure, which you'll see here. The final thing to mention on this new supplementary form is there's been some teething issues with the validation rules set out for HMRC. In particular, we discovered that step 2 and step 3 amounts brought forward could not be treated correctly in all circumstances. HMRC have now acknowledged this and advised that they will be issuing a further update to the e-filing service in May and will be including support in our next release, which is due in June. The advice currently is that for taxpayers affected to hold off submitting for their return for the time being. So that's an overview of the CTGOOL, and as far as updates to the main form go, thankfully these are more straightforward with just a handful of new boxes. Again, I hope everyone can see these screenshots. The first relate to capital allowances, and as many as you will know, in recent years, the government have been using first year allowance system as a way to control behaviour, and we've seen environment friendly types of expenditure qualifying for first year allowances. Expenditure on zero emission cars is the latest one to be included, and it relates to a change that the government had pre-announced as being introduced in Budget 2021. For those interested, this is a change in the Capital Allowances Act 2001, section 45D, and currently the limit stands at 50 grams per kilometre for cars, but this limit is going to be reduced to 0, and the allowance will be available through to the 31st of March 2025. Then we have also seen new boxes introduced in respect to the COVID-19 support schemes that started to run last year, and the government are trying to crack down on any incorrect or potentially fraudulent claims that have occurred. So we've seen 4 new boxes for a business to declare if they overclaimed under the coronavirus retention scheme or the job support scheme, and any amount overclaimed will be included within the return. It's important to note that the guidance notes clarify that although the company tax return is being used as a mechanism for disclosure, these amounts are charged at income tax rather than corporation tax and are so to be collected separately from HMRC. And then finally, there's also a new box for businesses to enter the amount of eat out to help out reimbursement they received and to confirm that this has been included within their taxable profits. Of course, Alphatax has been updated to include inputs as appropriate on the appropriate statements to enter the relevant amounts. So for zero emission cars, the relevant inputs will appear on the plant and machinery main pool input statement. And the coronavirus job retention scheme overpayment inputs appear on the repayment detailed input statement. And lastly, the eat out to help out box is on the return detail statement. The second major change from a form perspective relates to the tax return for non-resident companies, or NC liable to income tax, which is referred to as the SA 700 form. As we know, under the territorial basis of tax charge, companies that are resident in the UK are chargeable on their worldwide income and gains. But if you're non-resident, then you're only chargeable on certain specific types of income arising in the UK. The two main examples of that income you would see are a permanent establishment, which means you're carrying on a trade of some sort in the UK. And here you would have always been subject to corporation tax. And the second common example is rental income from UK property. And previously you would have been chargeable to income tax here, and the form, the SA 700, would have been used to capture these amounts. However, following changes in 2019, that income stream has now been brought into corporation tax, which, as you can imagine, was quite a shift. And these changes were included in the previous release. But the 2020 version of the SA 700 is the first annual return to have these property pages removed. And of course, we've now reflected that in the product. So there's still a few income streams that are left on this form. As you can see here, this slide, we've crossed out the ones that have now been removed in favour of corporation tax. So it hasn't gone away entirely, but by far the biggest sections have been removed. So it'll be interesting to see how many customers who previously had to consider this will no longer have to going forward. Of course, for the income streams that have been crossed out, they will now be completing a C600 instead for these income streams. The last form we support is the partnership tax return, the SA 800, and again, this is annual form. Not too much of an update on this form this year. Essentially, it's the same as last year, but there are two new boxes that customers may need to look out for, and again, these relate to COVID-19. On the partnership statement, like we saw for the C600, there's now a box for the amount of coronavirus job retention scheme or job support scheme incorrectly claimed to be allocated out to the partners. And in the declaration section, the signatory for the return now has a tick box to say that they have included all coronavirus support payments within their taxable income. Aside from forms, there are a few regulatory changes included in this release that we can also talk through. The first of those relate to carry forward losses. Many of you remember us talking about this back in 2017, when the whole of this area was rewritten with increased flexibility for carry forward losses, alongside a 50% restriction for the largest of companies. Relief for capital losses brought forward at the time was intentionally omitted from these changes, but the government have now changed their minds and decided to bring these amounts into the rules in the last Finance Act. So there's a new section 269 ZBA restriction that slots into the existing rules and works in a similar way. As you can imagine, this was quite a big piece of work for us, and we included most of the changes in our previous release. So this release, 20.1, includes further work to cover some of the more edge case cases, which are pre-group capital allowances brought forward can now be swapped out for current period losses, so-called companies without a source of chargeable income, which would lead to, which means those disposing of interest in UK land, which will result in one-day accounting periods. There are now specific rules relating to the deductions allowance available to them. Insolvent companies also get a special rules for the deductions allowance available to them. And last but not least, life assurance companies, who essentially have three separate capital loss restrictions all rolled into one. So new calculations have been added in the release for all of the above. The next change to talk about is to do with the corporate interest restriction, which I'm sure you all know is that big and somewhat rather confusing large group calculation that limits the deductions of interest in the tax computation for UK companies to a certain level. This regime includes a specific return that must be submitted to HMRC, eventually called the interest restriction return, which lays out details of how you arrive at your numbers. That return, as it stands, can simply just be a series of statements produced by software, and this is the approach that Alphatax currently takes. Users can then print off these reports to PDF and submit those to HMRC via the provided portal. However, HMRC have decided that they would prefer a more standardized submission route. And back in 2018, they introduced an Excel template for this. However, as they did not make this route mandatory, software developers such as ourselves did not choose to support it. And it was easier for both us and customers to continue using the current PDF and portal approach. So HMRC are having another stab at this, and they've introduced an API to be used as the standard submission mechanism. The term API comes up quite a few contexts at tax at the moment, but is essentially just a means of a two-way process whereby software can retrieve information from HMRC and send information such as returns to HMRC. HMRC have stated that they intend this to become the mandatory route, but importantly, there's presently no time frame at all for when this will happen. However, we are intending to provide support for this submission route when it comes in, and have been making some progress on the project to get that interaction with HMRC's APIs going. In the meantime, though, for the 20.1 release, our tax development team have completed an exercise of reviewing the APIs to check what we already had matched, and we've included a new statement to include a small number of new fields. And this also gives us a place to hang further information for users to give more clarity. So there's not much for users to be aware of at the time being, other than the fact that we think this is coming and we plan to support it. And we'll be issuing further updates in due course when HMRC settle on timeframes. For the time being, CR submissions will continue to be via the PDF and portal process. The next area is patents, and like research and development, this is an area where government provides specific tax relief that is intended to be an incentive to those to look for new product, which of course helps the UK economy grow. The UK patent box rules were introduced in 2012, and the headline for this regime was that it provides a rate of 10% corporation tax on the income from patents, which of course is significantly lower than the main rate, which is presently 19%. However, as we've all come to accept, tax is never straightforward, and there's not actually a 10% rate at all. What you do is perform a calculation which reduces your taxable trading profits by a proportionate amount, which has the effect of when you tax those profits at 19%, you're effectively applying a 10% rate on those income streams. The calculation involved gets quite technical, but originally it was performed on the basis of the trade as a whole, which could incorporate a number of different patterns. However, following recommendations put forward by the OECD BEPS project, the UK was required to move the calculation to be applied on a more patent-to-patent basis, known as streaming. Those rules were brought in 2016, but there was a 5-year transition period which ends from the 1st of April 2021. Again, we did include these changes in this area back in 2016, but as you can imagine, we were more focused on the 2016 rules at the time. So this release, we've taken the opportunity to come back and have another look at this area and introduce various changes to tidy up both the presentation and the display rules of our statements to ensure a smoother transition for users. The final regulatory change is around IFRS 16, which relates to accounting for leases. Leases are a big part of many businesses' operating activities, and from the diagram, as you can imagine, from accounting and tax perspective, there's a fair amount of complexity here when two parties, or sometimes more, with a single asset and money changing hands, you're trying to work out who owns what and where the taxable income or deduction sits. Previously, those considerations would have led to two distinct classifications for leases. Firstly, you had operating leases, which were more temporary, and businesses would just pay a monthly fee, perhaps to use the asset, and then at the end of the contract, simply hand it back. There were then finance leases, which are more akin to the business actually owning the asset, but paying for it over time. In both cases, it was the leasee, being the person who has use of the asset, will have the deduction in their accounts, which presently will be either rental payments or interest plus depreciation. So that was the position before IFRS 16 came along. And the main thing that this new accounting system standard, was to remove the distinction between operating and finance leases. So you just have a single lease model. The main implications from a tax perspective in the computation where depreciation is an allowable deduction under HMRC Statement of Practice 391, and for the purposes of corporate interest restriction, have amounts of interest and depreciation here. So you have to work out how these amounts should be included in your computation. So we have 4 separate enhancements all tied together for this release. Just to show you those quickly, the first is a reasonably simple but significant narrative change on the column of the fixed asset statement and the other statements which refer to this column. This was previously referred to finance leases specifically, as this was the previous treatment, but we've now changed the term to ROU for right of use, which is used in IFRS 16 to show that a broad range of leases can be entered in this column to achieve the correct tax treatment in terms of having depreciation as allowable. Second is a new reconciliation statement that's entirely optional, but should you wish to use it, will track balances for any number of leases that have been included in that right of use lease column on the fixed asset statement. Third relates to those companies who've had to consider the corporate interest restriction. And whilst the distinction between finance and operating leases was removed in the tax computation, generally, it's not the purposes for CIR. Accordingly, companies are still required to determine what proportion of any depreciation or interest relates to assets that would be classified as operating leases. So for depreciation, we have a new field on the depreciation and amortization statement for the amount of any SP 391 depreciation, which relates to operating leases. Can be seen here. For free format computations, an equivalent field will appear on the fixed asset statement. The effect of this input is that the trade or non-trade adjustments that allow us depreciation will be separated out into finance lease and operating lease components. And the result of that is for the purposes of adjusted corporation tax earnings, we can only adjust for the finance lease component only in line with the legislation. Fourth and finally, but also for CIR this time, on the interest side, we've extended the existing CIR analysis options that was available on the loan relationship input statements to now allow a category for interest that relates to operating leases. Again, this input does not change the treatment in the tax computation, and the interest will still be allowable, but for CIR purposes, interest relating to an operating lease is not treated as tax interest and so will instead form part of adjusted corporation tax earnings. So there are quite a few bits and pieces to that one, but hopefully that gives you an idea of the principles that you might have to consider when you come across it. So that covers most of the things we had to do, but we do try to find time each release to include some pure enhancements for things that perhaps customers have been asking for and enhancements that allow the product to move forward more generally. The first example to mention in this edition is a new investment expenditure summary statement. Under accounting standards, there's actually a requirement for entities to list out their subsidiaries in their accounts for each period. And this screenshot by way of example is taken from British Airways public accounts. But for quite some time now, we've had customers from time to time ask if this was something we're going to include in Alphatax. But until now, we had not quite been able to make its way to the top of our ever-growing to-do list. However, over the last year or so, we kept noticing in unrelated support customer files that they contained a free format for doing this themselves. So we decided at this point, it had reached its tipping point, and the idea was sufficient enough for us to consider adding a fixed statement. So this led to the introduction of the investment expenditure summary statement, which you'll now see will appear in the balance sheet analysis section of the contents tree. Again, this is completely optional to use, but if users do wish to use it, it will track the value of cost versus impairment and therefore net book value for a number of investments across periods. The statement does not generally interact with the rest of the computation, except that any amount of impairment charge may come from the profit and loss account, and that will then be treated as disallowable for tax purposes. And upon a disposal, the user would need to be looking at creating a capital gains disposal, in which case this record of historic cost will become useful. And the final area for me is in tax accounting this time, which is a big area of the software and an area we've been trying to chip away and improving over the last few releases. There are a number of further changes to tax accounting, including with this release. I only have time to show you one of those, which is in the group module, and it relates to the process by which customers would create a consolidated version of their tax accounting reports. Where the insertable row in the reconciliation was used, previously the best we could do was simply return a sum of the total amounts entered, which is not great as you lost the granularity, and really the reconciliation is the key area that customers are concerned with, as this ties back to the published accounts. So in this release, we've added a new system whereby you can set up insertable rows in the group module and have those post down to the company computations within the group. Users can then populate their company amounts as appropriate, and then when they refer to the group, those amounts will be linked back up to the individual rows. So that's everything I aimed at and had time to cover today. Hopefully that gives you a flavour of what we've been working on. There were also a lot of smaller changes that we did not have time to mention as well. For those interested, the release notes would be the place to go to read the detail of all the changes made under this release. And please, as always, remember, you can always reach out to our support team should you have any questions on these. But looking ahead, Budget 21 was held on the 3rd of March, and we have a finance bill which is currently making its way through Parliament. That bill includes the CT rate change to 25% from April 2023. Along with the introduction of a small rate and marginal relief, which will be a bit of deja vu for someone here. And as well as there's several capital allowance changes, including the extension of the 1 million AIA allowance for a further year, 130% super deduction for plant and machinery expenditure, and first year allowances for Freeport tax sites. The tax development team are hard at work, as always, I like to point out, getting these changes ready, and are working towards the next release, which is expected in June. So again, thank you for everyone for attending. I hope you had some benefit from it and are interested in all the changes that we've been working on.